Thank you, Mark. Yeah, look, as you were saying, Mark, since we last caught up, a fair bit's changed for Cash Converters. We've had a couple of significant acquisitions and further developments. Just reviewing our business segments, and I'm delighted to be here. Thank you for having us to talk about that. I did think I'd just start with a bit of a refresher on Cash Converters. It's obviously a business that has been around for nearly 40-year anniversary this year, so for a long time. But over that time, it's really changed a lot. I think the best way to think about Cashies in the modern day is that we do still operate that store retail buy-sell network that we have been known for over time. But what's really developed over recent years is the personal finance business, the service of our customers requiring small loan amounts. And the two businesses operate in tandem, very well. We'll talk about that. And over time, we've invested in our technology heavily. So whilst we're known for that bricks and mortar retail network, we have a very sophisticated online business servicing retail customers and our finance customers as well. We did grow originally through a franchise model, starting out of WA, expanding nationally, moving internationally. But our core markets we focus on are really Australia, New Zealand, and the UK, and we'll talk about that in a bit. I did want to show a video of a store, which I'll play now, just to give the viewers a feel for the changing feel and look of the stores. Hopefully you can see that video, Mark. Hopefully that played okay, Mark. So whilst the stores are still in place, the inventory mix has really changed to a higher end mix of inventory. The circular economy element of our business is still very key to our business model, buying and selling and repurposing goods. But in the overall scheme of things, when you line that up against the personal finance business, that store segment contributes about a third of the company's earnings and 2/3 coming from the personal finance business. So, you can really see the need in the community for the personal finance service that we offer. It's really appealing to about 3 million Australians who, for whatever reason, struggle to access credit and regulated credit in Australia. And we'll talk about how we do that. But the Cash Converters brand is highly trusted, unaided awareness of sort of 90% when market surveys are run, very well known and regarded, particularly in our customer segment. And as the market's changing, we're reaching a wider customer audience, which is exciting. Just briefly, in terms of our business model, we operate a very large business. We deal with a lot of customers through various touch points, but we process, around 600,000 retail buy-sell transactions through our stores a year. So someone coming in, selling an item, someone coming in and looking for something, generally more value-conscious consumers. But as I say, that inventory profile is changing. We're reaching a more middle market than we have done in the past. We receive circa 780,000 applications for small loans a year, and we're operating online where that's a high volume, a lower approval rate environment, and we're sourcing personal loan applications through our store network. And the stores are important with the personal finance business because it's a much stickier and more direct relationship with the customer than an online applicant. but both channels are important, and I think it just shows that need for cash in society. There's definitely a growing pressure on customers with cost of living. I think the advent of buy now, pay later a few years in has people concerned that they're losing control of managing their expenses and their credit. And they're coming back to cash converters and other regulated non-bank lenders such as ours to deal, which is great. With nearly 100,000 active personal loan customers in our loan book, it's a big business with a lot of transactional data flowing through. As I mentioned, we do operate what we call corporate stores, company-owned stores. And I think the best way to think of that is really the franchise network model that was originally the preferred model for growing the network. Over time, we've been buying those franchise stores back, and we'll talk about why that's a good idea. But, of the 150 stores in Australia, we now own about half of the network, 75 of those stores, and 75 remain franchised. We operate online and globally, and we'll talk about that in a minute. I think really central to our business model now is technology, and it's front-facing, customer-facing apps and mobile websites and customer self-service capability, where our customers can log on online and check loan balances and make loan repayments and download loan statements like you would with a bank. And also all of our retail is offered through what we call our web shop, our retail site. And, whilst it's displayed in store, it can be dispatched, nationally. And we do often sort of partner into the leading online commerce sites who are looking for eyeballs and inventory and listings. Our store offers the opportunity for someone to go in if they're local and view the item. But all of the inventory that we sell is backed by warranty, returns policies, and has the backing of a trusted brand behind it, where I think people feel comfortable buying from us. So if they have an issue, they'll be well serviced. Predominantly, though, the technology that we deploy is really around our credit models, because our borrowing customers don't have a lot of mainstream data available. So we really don't rely so much on a credit file like a bank would. We load the bank statement information for a customer and other data points and build our own credit profile of that customer and our own risk score to determine, really we're trying to predict the propensity to repay when we're giving someone a loan off fairly limited data. So we build our own credit over time, and that's really important. And, the product offerings we've got in that personal finance business, small, medium loans, it's that sort of loan size showing on screen. And the retail buy sell, as mentioned, and we do have a small income line for franchise fees, and I'll just talk about that on the next slide. So the business model shown here really it's depicting a global model, but as mentioned at the start, we're very focused on Australia, New Zealand, and the UK. The orange bubbles there show the corporate operated and owned stores in those markets that we own and run. And the other stores in those markets in the grey bubbles are franchised. And that provides optionality for the company going forward to continue buying those stores back and folding them into our network. And it's a low risk way for us to continue to grow our earnings. It allows us to, in some instances, fund existing franchisees to then continue expanding and growing the good operators. We won't introduce new franchisees into our model per se, because our strategy is really to take control of the networks in those key markets and continue to own those stores. The rest of the world, we run a license master franchise or license operation, and our partners there really use our brand and our IP, but they operate that business as a standalone entity in those markets. It gives us good brand recognition globally and exposure more than anything in those other markets. In terms of our financials, the company market cap is around 138 million at 30 June. We did put out an unaudited Q4 update, calling out full year revenue at 382 million. That's up about 26% on the prior year. Our gross loan book is trending up to 300 million there. We've got a strong balance sheet with 50-odd mil of cash on the balance sheet, and generating really reasonable EBITDA and net profit. We've been paying a 2 cent per annum dividend for the last 3 years, which is a yield of around 10%. It comes fully franked. So, we really try and balance the business, investing for growth and making that return to shareholders. Like I said, with our technology, it's such a core part of this business now, and it's not to be underestimated how important it is and how hard it is to replicate what we've built. It's a real barrier to entry to this market. You need a lot of relevant data about this customer segment to train your credit models and to make the right lending decision, and also to meet your compliance obligations and really build a complete picture of that borrower at that point of application. And with a lot of volume, it enables us to do that. And then we've plugged the business into the open banking and new payments platforms. It just essentially means that we can shift cash instantly into bank accounts for customers and take payments. We use technology to authenticate products, like handbags, for example, where we can provide an authenticity statement. It's really enabled us to open new markets and engage in different product lines that are, you can imagine, quite hard to value and assess at times. So the business has really pivoted into a big tech house wrapped around an old business model, really. The look and feel of retail, you sort of see in that store video, the newer concept stores in Paran and South Melbourne and soon to be Bondi, smaller footprint, higher value inventory, a really different sort of mix and feel of handbags, collectible sneakers, trainers, high-end watches, jewelry, and electronics. And it's attracting a new market, and it's a lot more, I think, acceptable nowadays to embrace the circular economy, particularly in a younger cohort of consumers who are more concerned about the environment and reuse. And this is less stigma attached, I think, to purchasing pre-owned, which is terrific. And we're right at the center of that. In terms of the finance business, like I say, that's the bigger engine for our business, and something that's really grown strongly as the banks have moved out of, they're a risk-off sort of environment for the banks where they'll only deal with prime borrowers. Where the banks are looking at the prime finance market, that's a credit score of sort of 800-900. Our customer scores are sub 500. So we're really dealing with borrowers who have irregular income or have had an issue with credit in the past. And that's really our specialty, risk assessing these customers and serving that part of the market. And it's a big and growing market, as you'd anticipate, with the cost of living pressures on customers at the moment. We're just seeing more and more applications coming to the business. So it's demand growing, and we've only got a very small slice of that market at the moment. Just briefly, the highlights, Mark, I touched on good revenue growth, strong loan book growth. I think the key with the loan book is too the diversification of the loan book. We were known for small loans. We've really moved away from that part of the market as we've started offering new product releases and opening to a wider range of customers, and also offering our good repeat customers lower cost loan options over time. And innovating and further driving the business in that direction is what we're all about. And then to close, our strategy really simply is to continue buying back those franchise stores where the owner wants an exit or we see some strategic value, and expanding our network by doing that, and innovating and offering new loan products and growing the current loan books as sectors of the credit economy become regulated that weren't prior, like, buy now, pay later. There's a lot of focus on potential consumer harm in that market, which is a good thing, I think, for consumers. And, strong balance sheet and continuing dividend payments is really our core focus. My apologies for dropping out, Mark, but I'll leave it there. I'm happy to take any questions.
Okay, perfect. Yeah, we've had a few come through already, Sam. So the first one is, and I think you probably would have touched on it in the preso when before we lost you there for a minute or two. The vehicle loan book, you've taken the decision to exit that particular offering. And the first question, we've got two questions around. The first one is, as that book is kind of generally wound down and matures and it kind of rolls off, is that going to be replaced by growth in other books, or is that capital going to be redeployed into something else? Maybe
Hmm.
just give us a kind of where to from here as the vehicle loan book unwinds.
Hmm. Yeah, great question. I think, as the third biggest provider of vehicle finance in our part of the market, we just took a view that we were subscale, and the amount of our cash equity, our cash in that book was high. It was about half of the loan book, and the return on that capital was substandard in terms of where we could redeploy that capital to generate a better return. So we went through a sale process. We decided we've got confidence in our provisions. We will run that book down. 50% of that book will come in over the first year, and maybe 90% of that cash over 3 years. And we'll take that cash over time, continue growing our core loan books, and use that cash to acquire our stores back. And both of those avenues generate a superior return on that capital than leaving that in that loan book.
Okay, I think you've touched on the second question as well. There was a question on, profitability margins as you kind of exit the loan book. Is it kind of going to be recycled into higher margin, higher profitability products? But it sounds like it is.
Yeah, correct. Yeah, I think that vehicle market, it's a tough market to play in. The value of that security at times is questionable. They're older cars. You're out repossessing a car from someone who's not paying. It's not a great consumer experience. So redeploying that capital into our core Cash Converters branded business is where we're really focused now. That's what we do well. So that's what we'll continue doing.
And then a question on the buying back of the franchise stores, which is kind of continues in the background all the time.
Mm.
A question on, when you take it back, how does the profitability improve? Have you got like an example you can refer to? And when you take one back, do you find more loans get written through that particular franchise, or is it, better inventory stock turns controls, is it that side that lends itself to the improved profitability?
Yeah, I think our franchise network, I mean, first of all, it's a strong, profitable network. The businesses are profitable, and the owners have been in the network for a long time. So the exits are generally people looking to retire, and later in life they're looking for an exit. The way we look at these businesses is that we've got complete visibility of top line revenue sitting on our point of sale platform and our lending platform. But their cost bases will adjust for corporate ownership. So, we'll dial the cost base up in summary, just put a bit more resource into that store generally. And then we'll look at that earnings profile as a result of that and apply a multiple 3.5 to 4.5, something like that generally, depending on the nature of the network. Bringing them in, so the value accretive, but they do enable us to then accelerate our product development release. I think the business as a franchise model, as a starting point, will likely continue to morph to a corporate model over time as we essentially defranchise and drive the financial service business into the new market that it's sitting in now.
Okay. And then, as I kind of said at both our presentations in Melbourne and Sydney at the live events, regulation never too far away from this business. A question around, they're saying, they understand the rules and regulations around SACC, so your small loans, but maybe touch on, rates and repayment regulations around the MACCs and the larger size loans that you're starting to move into. While it's not
Mm.
I guess a large part of the book right now, it's kind of where the book is trending. So just maybe, is there a
Mm.
difference in the regulations once you kind of go over, and is it more favorable or kind of less favorable versus the small ones?
Yeah, look, firstly, we are regulated. That's not always known. I think that's a real advantage. We don't have to go through the possible pain that the buy now, pay later sector, likely will be heading into. We're very well regulated. There's good credit policy around this space of the market. With the medium amount loan, you can never say never. So we've innovated another loan product, that line of credit, and we'll continue doing so to diversify our overall loan book. But I think the core premise of our customers need cash. They need support to buy a washing machine, repair a car, meet life's unexpected expenses. And we do it in a highly regulated way, sitting under ASIC and AUSTRAC. And, I think I'd imagine there'd be tweaks to regulation over time ongoing, as you'd anticipate, which is a good thing. And we're all for that. And we've got a front seat with Treasury and ASIC on that in that respect. But I think the Mac product itself, because the headline costs that people get concerned about are lower in the Mac and then lower again in the lock. We've moved the business into that space that I think now advocates and regulators are comfortable with.
Okay. And then just one from me quickly. I know, the UK business is a considerable part of, cash converters overall business. And as you said, a focus area. New change in government there. And I see, Rachel Reeves, the new chancellor, she's, been kind of outlining what she wants to get done. Is there any noises coming out from the new government, promises that might turn into policy, but changes that you're kind of expecting there on the positive or the negative that, shareholders should be watchful of, or you're watching out for as she kind of heads into her kind of first budget and kind of first term in office?
Yeah, I think it's a great question. The UK, we don't offer an unsecured loan product in the UK. It's only pawnbroking, and that's the market in generally due to some historical regulatory changes. There's a big need for cash in the UK too, as you could imagine, and there's in general a walk back of some pretty punitive credit changes that happened over time. So if anything, a new government, it brings an opportunity for them to review supporting this part of the economy. The biggest listed pawnbroker in the UK has a book of around £100 million. We're at sort of £5 or £6 million. So, it's a big growing pawn market, and it's a well-regulated product. So I think opportunity in the UK to continue growing that pawn book is huge, and something we'll stay focused on. But in general, I mean, New Zealand and the UK have taken, a really, really restrictive credit policy to subprime support and near prime support, and they're having to walk it back because the need is there, the need is growing, and that unintended consequence of making it harder for people to get regulated credit means they go into unregulated markets. And I think politically people are realising that's not a good outcome. Have a bigger regulated provider of credit in this space is a better outcome. And, we sit front and centre of that in UK and Oz, so it's a good opportunity for us, I think.
Okay. Sam, we're bang on time there. So thank you very much for joining us. And I know you're joining us from Melbourne because you were down at Techno. So safe travels back to WA, and we'll hopefully catch up with you sometime in the back end of 24 here.
Look forward to it. Thank you for having me, Mark. Good to see you.